Hello and welcome. Thanks for tuning in to this presentation. I'm calling this Navigating Tariffs and Volatility, and I'm purposely giving it a byline of perspective for long-term investors. Everybody that's listening to this, I am assuming is not a day trader of some sort. If you are, then this presentation isn't for you anyways. The other thing that I want to make clear up front is that this in no way is meant to be political. So anything that I say, I'm not taking sides with one political party one way or another. I think you'll really see that this is just meant to give you perspective on the markets themselves. It's been a very busy last couple of weeks trying to reach out to folks. And I'll say this, about half of the people that I've talked to are looking to add money. All right, so this presentation isn't necessarily for you. This is for the other half of folks that I've talked to that have had some concerns about the market. And we'll go through here on hopefully by the end of this. Again, I'm not going to try to make anybody feel better, but my real purpose here is just to give some perspective on what I think could happen and some sort of do's and don'ts. All right. So let's just start at the very beginning. What is a tariff? What are their purposes? So, a tariff really is just a simple way to think about it. It is a tax or a duty that's imposed on any good that's imported by some other country, right? And the purpose of them is to try to protect domestic industries. So, if you're trying to encourage either local production or to generate government revenue. The other intent is often to reduce reliance on foreign goods or to respond to other trade policies, excuse me, of other nations, right? So it could be in retaliation is the word that keeps coming up to another government doing it. But really the ideal purpose is to make prices of goods in other countries more expensive relative to whatever that same good or similar good is in the base country. And by doing so, it makes by making it cheaper, relatively speaking, it increases demand. So the potential impact, of course, of these is that it does raise prices for consumers. Why consumers? Well, because businesses, for the most part, instead of them paying the company that's paying for the higher costs of goods, instead of them paying for it, they then pass on that higher cost to the end consumer. The other thing that can potentially happen is the trade relationships themselves with other countries can get wonky, which is obviously what we've been seeing here this spring of 2025. And the other thing that can happen is it influences economic growth. Why? Because it can increase the cost, it increases the uncertainty. And one of the goals of having tariffs, is that let's just say it's the US, for example, the US is trying to have more manufacturing done here. The problem with that is that doesn't happen overnight, right? Like let's just say you're a widget maker and you've been importing goods from, pick your country, China, Mexico, wherever, and you decide, you know what, it's going to be more expensive to do that. Let's just make them here. Fine. But now there's a bunch of other decisions that have to be made, right? Like, so where do you put the plant? How big of a plant? Do you try to replace all of the production here, right? So all of these things don't just happen overnight. I wanted to give some perspective, and I know that the writing on the chart is really difficult to read, even as I'm trying to read it myself. It's very difficult. What this is the S&P 500 starting in 2017. So if you remember, this is when Trump started his administration back sort of the first time around, right, when he was number 45, and goes through the end of 2019. And it's really meant to be a snapshot of what happened first time around with tariffs that Trump announced during that presidency. And part of what I'm trying to show here is that the first part of this was during 2017, and he was trying to do. It started with steel and aluminum imports, that he was going to put tariffs on that. Uh, there was kind of a tit and tat with China on intellectual property. And then there was some stuff on US solar panels and washing machines. The interesting about that is that had zero impact on the stock market. In fact, 2017 is actually one of the lowest volatility years ever on record. We had, I think, never had more than a 5% move in a month the entire year, which is really, there was no drawdowns. It was a really low volatility time. Then we start to see things escalated in 2018. And yes, there was some response in the market. Towards the end of 2018, there was actually resolution around some of the trades, but the market went down. And the real thing that I'm trying to show here is yes, tariffs historically had an impact the last time around on the markets, but there was so many other factors driving the market that it did not play a role. And the impact that tariffs had last time around were very short term. Why? Because the common result was to renegotiate. So that to be determined on whether that'll be the case here. But I just want to make the point that last time around, there was really zero correlation between tariffs and market performance. All right, this is just kind of historical perspective. I just thought this was interesting. If you're a history buff at all, you'll like this. If not, this will just be more boring stuff for you. So sorry. I thought this was kind of cool. This was the average effective tariff rate that the US has put on imports going all the way back to basically our founding year. The data starts in 1790. And you can see we had very low rates. They kind of peaked around the early 1800s, right around the Civil War. They dropped to about the lowest that they had ever been historically. Um, I was going to say I don't know, there's some other interesting history things here where there was, I forget the name of the act, but there was an act that was put in place during around the Civil War, which is when you kind of see this pop up to 47%. Some say that helped to cause more fighting during the Civil War between North and South because the South tended to be more of a net importer of goods. So the Tariff Act that was put in place then negatively impacted the South much more than it did the North. Anyways, then we kind of saw tariff rates drop. They peaked again around 1930. Why? What actually happened then is in 1922, there was something called the Fordney-McCumber tariff that was put into place. 1930, the one that we kind of keep hearing in the news is the Smoot-Hawley Tariff Act. And the goal of that was in 1930, if I didn't say that. The goal of that one was to protect domestic industries, primarily farmers. Ultimately, those actually led to retaliatory tariffs from other countries, and it actually hindered global trade during that time. We saw it take about 20 years for tariffs to sort of go away, and we've seen really from the last 40 years, from 1980 on or so, essentially zero, right? There's basically been no tariffs. This is looking at it from a little bit different perspective, which is to say, how much of the government's revenue comes from tariffs? Interestingly, when the country started, it was 100%. We didn't have a tax system yet. So all of the tax revenue, or I shouldn't say their tax revenue, all of the revenue that the US had came from tariffs. And then again, we saw fairly quickly, within about a 30-year time frame, 20-year time frame, the US got rid of them, right? And it dropped to being half of its total revenue. And we can see today, and really for the last 70 years or more, that tariff revenue ends up being essentially no part of our federal receipts. Why? It's because trade agreements, right? We put trade agreements in place so there has been no tit for tat. So this is sort of a more recent encounter that we've had with facing tariffs. Anyways, I just thought that was an interesting historical perspective. We'll move on a little bit. We'll get more into the markets here instead of tariffs themselves. Sorry about that. This is just trying to show how asset classes have done relative to the S&P 500. The S&P 500 being this red one in the middle. I have this up to date through a couple weeks ago, through March 21st. And at the time, the S&P was down about 3%. Interestingly, this year, what we actually saw so far was the EFO, which stands for Europe, Asia, and the Far East. It was actually the best performing sector. The one thing that I want to really point out to you is this dark blue box, which is for a balanced portfolio. This is generally what most clients have. And the point that I want you to see is how it performed in any given year. A balanced portfolio was never the best performing asset class, but it was also never the worst performing asset class. Right. So I always say if you want to ride the roller coaster, just pick one individual sector, right? Like invest it all in small cap stocks. You're going to be the best performer in 2010. You're going to be down the next year. You're going to be up, 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 down, down, all over the place, right? And it's the worst performer this year. If you want to ride the train, just have a balanced portfolio. Again, you're never going to be the best, but you're never going to be never be the worst. I thought this was kind of interesting. This goes back to the S&P 500 going all the way back to 1950. And we've seen more than 30 corrections going back, what is that, 75 years. A correction is considered a 10% drawdown or more at some point during the year. That's happened 30 times, right? We're in one right now. And what really stuck out to me, this is a plot of every single one of those from both its drawdown, so the time that it was going down, until point zero, to where then that was the bottom and started to recover. There's a couple things that stick out to me. One, oftentimes the most common thing to happen is that a drawdown can take several months to happen. But historically, the recovery is actually quicker. So this was how many days it took to hit a bottom from a previous peak, and then how many times or how many days rather did it take to recover the previous losses. On average, it took about 4 months to recover a previous loss, and the average downturn when we had one that was more than 10, the average was 14%. So I thought that was pretty interesting. Some of the reasons that, market rebounds often begin during times of maximum pessimism, right? It's not like there's some crystal ball. I always joke around. I have a crystal ball on my desk, but it just shows myself upside down. So that doesn't help at all. There is no point where you just go, "Yep, that was the bottom. That was the low point," right? We have no idea when that is going to be. Um, Oftentimes those happen though when things still are very pessimistic and negative headlines are all over the news. So it's not like we just, right? I guess my point is there's just no way of knowing when that happens, but this kind of shows that even during the times of maximum pessimism, the recovery is often much quicker. Sometimes the question comes up, should we go to cash? All right, now I'm going to basically spend the rest of this presentation just showing you why I would make zero changes to your portfolio. Okay, and I'm going to start with this chart, which shows the the return on cash going back to 1990. So we have about 35 years worth of data here to show what the return on 6-month CDs are compared to inflation. And that's the important part, right? Is compared to inflation, because if the price of goods are going up like they have been this year, you could earn a positive rate of return on a CD, but it's not really going to mean much if the cost of everything is going up more than that, right? Like there were stories about eggs earlier in the year being ridiculously expensive, right? So that's just one example of a good that you might purchase where the cost is increasing. Healthcare, right? The cost of healthcare increases often higher than the rate of inflation. What you can see here is the yellow line that is on the screen shows whether the income that you made from a 6-month CD, uh, how that compared to, it was like the after inflation number. And if it's above zero, that means that you really did make a positive return, right? That's good. That game kind of ended in about 2003. During 2008, when the global financial crisis happened, interest rates became more normalized. So there was a time frame again where it sort of worked out to be in cash, but that was also very short-lived. And again, basically for the last 15 years or more, it just hasn't made sense to be in cash. And we can see even today, the inflation rates are much higher than the rate of return that we can get on cash. So again, this is my first example of why you shouldn't be in cash. All right, I'm going to give you one more. What if we just sit in cash for a little while? Well, what this shows is this data goes from the last 25 years, so it's S&P 500 from the year 2000 till today. I think I did this through the end of March 2025, and it just shows what if you stayed fully invested no matter what, how would you have done? All right, so that's the big green bar. Then it compares it to different things. What if I just sat out for a little while? So this is saying, hey, what if we waited until there was a 2% move down and then we sit in cash? For how long? Well, that's what the other bars show. So if you would have had at any point, any time that there was a 2% down move and you sat out for 1 week, you basically just cut your earnings in half. Even if all you did was sit in cash for 1 week and then got back in. So for 25 years, every single time that you did that, and waited for the market to go down 2%, sat out for a week, then got back in, you basically halved the amount of earnings that you could have had otherwise by just leaving it, If you, every time that happens, the furthest bar on the right is if you set out for a year at a time, because you're just like, you know what? I just want to punch out T-bills and chill, as they call it. I'm going to sit in treasury bills and hang out for a year and just let things go. You would have only earned $1,300 on an original investment of 1,000 versus earning a 400% return for just leaving it. I think that's pretty powerful. Here's another one. What about missing just the best days in the market? So this is kind of a little bit different time frame. I have this going from 2002 to the end of 2021. Why? Because there was so many other crazy things, right? We were still coming off the war in Iraq in the early 2000s. This has the financial crisis of 2008 and all the goofiness that we've had in there. But the question is, what if you missed just the 10 best days out of all of that time frame, 20 years? You would have had, instead of earning 9.5% return, you would have earned 5.3%. That's it. If you would have missed the top 20 days, you basically earned the same rate of return as you would have in cash. Here's the problem. So this is if you're just missing the top 10 days out of, what would that be? We got 250 trading days a year times 20 years. So this is 5,000 days of market performance. If you miss just the top 10 out of 5,000 days, you've cut your return in half. Here's the problem. All of the best days, all of the best days are right next to all of the worst days. Okay, so what this chart is showing, if you can imagine a horizontal line going across all of this, that would be that any given day that the market returns zero, a big blue line that goes up is showing that we had really large positive days. And you can see these are single day returns. There's single day returns of 5%, 10%. That's what these real big days are. This is a day where the market was up about 7% in one day in 2014. But what I did is I circled all these to show that all of these best days are at the same darn time as all the bad days. And so again, going back to this, even if you miss just a couple of those top 10 days out of 5,000 trading days, when you cut your return in half over 20 years, the tough part about that is they're right next to all of the worst days. So again, I have people, some people, half the people I've been talking to lately, they're like, I want to sit in cash. Well, guess what? This is right when the best days occur as well. And if you miss the best days, you basically might as well not have even been invested at all for the other rest of the 20 years. This is kind of a zoom in of that, of just looking at the 10 best days and the 10 worst days, going all the way back to the financial crisis of '08. And again, you can see there was large down days, 9%, 7.5% in '08. Guess what? the best one of those best 10 days was right in the same time. So this is the point is that again, you can look at in '08, we had all these real big 9% days in one day, but then we also had up 11% in a day. And if you strip out these green days, you basically, again, you might as well have just stayed in cash the entire 20 years, right? Because it just, you didn't end up making anything more than that. Even 2020, a kind of a recent example during COVID, that's kind of starts right in here with this 7.6% day. That was the bottom of the market, by the way. That day, March 9th, was the low day, the lowest point. And we still had some bad, bad days that happened after that. We had a negative 9.5% day, a 12% negative day in a single day on March 16th. That was after we set a low. But guess what? All of the best days were right in that same time frame. And again, that's what makes investing so hard is that the worst days and the best days are always right next to each other. And if we miss these green days, which is also when we would miss the bad days, but if we miss these green days, again, you might as well have just sat in cash for the last 20 years. I'm going to show this from a little bit different perspective. This is something that we call Monte Carlo analysis. Don't worry about the name. All this is trying to run, instead of one set of historical set of returns, I ran 5,000 different simulated returns. And so the point is that you can run through different market environments, all with, it takes me 5 seconds to do this instead of waiting, you can't run 5,000 different sets of history, right? That just doesn't work that way. Here's what's interesting. So this is an example of someone that retired with $1 million. I wanted to run or simulate a 30-year retirement. So maybe that's from age 60 to 90, let's just say. In the first year, we have them taking out 33 a month or 40 grand for a year. Why did I start that? Because this is based on what the so-called 4% rule is. We know that historically that's a safe starting withdrawal rate that oftentimes will last, has historically lasted the entire 30-year time frame. That actually was from 1962 to 1992, if you want to go look it up. But then this also increases that annual income by 3% per year. And this starts with a portfolio that is 70% stocks, 30% bonds. So balanced, maybe a little bit more aggressive, actually, maybe a little bit on the aggressive side. And then I have it rebalancing every single year. And the thing that I wanted to show here is that what these different columns are different percentiles of probability. The 10% probability is the most pessimistic. So out of those 5,000, these were the 500 worst simulations of that. And what that showed is that um, that still had someone starting with $1 million, even in a really negative, the most pessimistic 10% of assumptions or simulations rather, people were still ending with 580 grand, even though they started with $1 million. Okay. And all this is just rebalancing every year, right? And you might say, well, did they have bad years? Yeah, this was actually the worst. We were assuming that the maximum drawdown was 58% at some point. So these were very pessimistic numbers. Okay, cool. Let's see what happens. So by the way, there's this probability of success number, 95%. This is one thing that a lot of times we'll look at when we do a portfolio simulation for someone. We're kind of looking for this number to be at 80% or higher. That gives us a really good judgment assessment to say that, yeah, whatever we do with your portfolio, if it matches that, we're looking really good. Okay, so this was a 95% probability. That's great. Let's change this. Let's just say that we had a 20% drop in the first year. So instead of having $1 million to start, we're at 800 grand. Everything else is the same. Okay. Now what happens is in the most pessimistic group, we actually see this thing running out of money in about 25 years. So not great, but what this shows is that the safe withdrawal rate was actually 4.6%. So if we would have stuck with that, we would have been okay. Remember, I started with a 4% return and then a 4% withdrawal rate, and then I'm increasing that by 3% every single year. That's not really realistic because by the time you get to say age 85, you're taking out probably an effective withdrawal rate of like 10%. Well, we know people just don't spend that much, especially in the later years. So, but the point is even that out of 5,000 simulations, it did not run out of money in 4,087 of them. So again, very high probability of success, even if in the first year we had a 20% drop. Now I'm going to change the situation just a little bit more. And this is again trying to make the point of why you should not make a portfolio change during a drawdown. So this is like the last example where we're assuming we had a 20% drop and we go super conservative. So we go 100%. We dump all of our stocks and go to 100% bonds and we never change it again. Now the probability of success is 1. And you can see even in the most optimistic rates of return, the portfolio still runs out of money in about year 26. So it just doesn't work. So again, my point is some people will say, oh man, we're having a bad year. I want to punch out and sit in cash. If you keep the portfolio there, the chances of that portfolio lasting for the rest of retirement is very low. It's very low. So the point that I like to make from all of that is to say that you can be short-term right, but then end up long-term broke, right? Like you can go to cash and in the short term, that might feel like the right thing to do. And you're going to stop the bleeding is what we hear people say. But in the long term, I can't find any scenario where that ends up lasting anything more than 27 years. In the best case scenario, the average is about 23 more years that the portfolio lasts if you go all the cash during a market downturn. It's like one of the worst things that you can do. This is just some good stuff to know. I think what this is showing is that I pulled out from the year 2000 to 2020. So this picks up the COVID year. And there's 2008. There's fourth quarter of 2018 was a really bad quarter. These are all the worst quarters that we saw in the S&P 500 for a 20-year time frame. And then we looked at what did the rate of return for bonds do during that time. And those are these dark orange boxes on top. And the point is that every time that stocks had a really poor quarter, its worst quarter, what we saw is that the return of bonds was positive. There's a couple examples. There's like one where we had a negative return in bonds during that time. And there's one that's where it's like it was up a little bit, but most of these they're up a couple percentage points. So were bonds a perfect hedge? No, they did not completely offset the losses that we saw in stocks, but they did create what I call the shock absorber, right? They did create some buffer, and so that's important. Like right now, that same thing is happening. Sure, stocks have not done well to start the year, but bonds actually have. And again, everybody that I manage money for has a balanced, some sort of balanced portfolio. So just know the portion that you have in bonds is doing well. I have this as kind of a joke, is to say, what if you were purposely trying to mess up your retirement plan? What would you do? Well, if you could pick a single most damaging mistake, it would be to just sell in a downturn. When the market plunges, it's tempting to stop the bleeding by selling out. But after selling, after a big drop, you're just locking in losses and then you forfeit any kind of rebound, right? History shows, as we've seen, that rebounds are often really quick. And if you're on the sidelines, you miss the recovery, right? So bottom line, go to cash. Just don't get back in. That'd be a great way to mess up your retirement plan. It's kind of related to the panic selling. And the thing that I hear is people saying, well, I just want to go to cash until things calm down. And the problem is then you got to be right twice, because now you got to be right when you get out, and then you got to figure out when to get back in. And it's that out of the market period that often coincides with when those best gains happen, as we saw. The other is, hey, let's just abandon the plan that we had. We know that successful retirement investing requires that long-term strategy, which is an asset allocation that you stick to, a diversification plan that you stick to, and then we periodically rebalance. I just did all of that at the end of January. We just rebalanced all the accounts that needed to be rebalanced. And the other thing I just kind of put on here is chase fads. That really hasn't been a part of um, this downturn, but sometimes I'll see people like wanting to jump to Bitcoin or whatever, name some weird investment. Gold has kind of been the common one. We also have actually seen gold coming off its historical highs. I think if you wanted to lose money right now, a great thing to do would be to buy gold because the chances of that thing going up from this point, I think, is really low. So I guess kind of saying this tongue in cheek, if you want to mess up your retirement plan, just do all these things and you'll do a great job of messing it up. The only thing that matters, I just want to remind you, is it's not what's going on in the news. It's not what your neighbor's returns are or your coworker or you read people on Reddit that they supposedly sold out in November of last year because they saw this coming. The only thing that matters is your progress towards your goals, right? And to a large extent, we're not in control of what the market does. We're not in control of inflation. Um, we're not in control of, what the president does. Uh, we're not in control of what the Fed does, but we are in control of what we do with our portfolio and what our spending behaviors are. So those would be the two things that I would think that are the most important is what are you doing from a budget perspective? If you need to barrel down the hatches a little bit while the market's down, there's nothing wrong with that. My wife and I were just talking about that with our own spending for the quarter. We had to make some cuts. There was some stuff we wanted to do in the Dells coming up and we decided to cancel plans. Big deal, right? So what? I'd rather just have the extra safety cushion and go from there. And the other is from a portfolio perspective, we can control what we do. And what we've seen historically is that jumping out of the market after some volatility is literally one of the worst things that you could do. Some people will say that this time's different, and here's what I'll say to that: every time is different. When we had the dot-com bubble burst in the late 90s, early 2000s, we'd never seen anything like that before. 2008, we had the financial crisis. We'd never seen companies making weird loans and then securitizing them, turning those into products and selling it. When that all went boom, we had never seen that before. Guess what? The market returned. 2018, we had weird stuff going on with tariffs. The market returned. We never saw COVID before. The market dropped, the market returned. And the same thing will happen now. It might not seem like it. All these things might seem like different scenarios, and they are. But guess what? People are resilient. The consumer is resilient. I think a lot of this is just posturing that will end up getting figured out. And again, history does have a way of repeating itself, and we've seen what can happen from a portfolio perspective if you jump out and miss those best days. So again, I'm always here to talk and go through your individual portfolio and your individual goals. That's absolutely what we're here for. But I just wanted to make sure that I'm presenting things that might help you anyways to stick with your portfolio. All right, that's enough. Thanks.